The most expensive Social Security mistake is not always claiming too early, paying too much tax, or choosing the wrong investment. Sometimes it is simply assuming that the earnings record behind your monthly check must be correct because the government already calculated it. That assumption can follow you for years. When was the last time you opened your Social Security earnings history and compared it year by year with what you actually earned? Not the amount deposited into your bank account, not the number printed on a recent benefit letter. I mean, the work record that sits underneath the calculation itself. You may have seen a frightening claim circulating that Social Security discovered errors involving 4.4 million retirees and that each affected person could receive an average of $7,800 in retroactive money by requesting a review this month. Pay close attention to this, because this is exactly where people can make an expensive mistake. I can find no official Social Security announcement confirming that broad claim. There is no verified General August program promising an average $7,800 payment to 4.4 million retirees for an earnings record review. That does not mean your record is automatically correct. It means you should not confuse a viral number with a legal right. The real story is more useful than the rumor. Social Security does maintain earnings records that can be wrong. The agency itself tells workers to review those records. Missing wages can reduce benefits. There is an official process for correcting an earnings record. There are situations in which a corrected record can cause a higher monthly benefit and past due money. There are also situations in which a missing year changes absolutely nothing. And there are separate situations involving a spouse, an ex-spouse, a deceased spouse, work after retirement, Medicare premiums, or a past Social Security decision that can change what you receive. But this is not automatic. Nobody can look at a headline, multiply a number by 12, and tell you that you are owed thousands of dollars. That distinction is the reason I want you to stay with me all the way to the end. I am going to show you the basic records you can check yourself before you pay anybody to find hidden Social Security money or hand a stranger your Social Security number, tax returns, bank information, or Medicare documents. The most important protection is not a secret code. It is knowing which record controls which part of your payment, because once you understand that, a salesman cannot frighten you with a number that sounds official. I have spent decades watching people make financial decisions based on one number on one page without understanding the machinery behind it. Social Security is a perfect example. Your monthly deposit feels simple. The money arrives, Medicare may be taken out. A tax withholding amount may be taken out. You see what is left. But behind that deposit are different systems with different jobs. Your lifetime Social Security earnings record is one system. Your claiming age is another factor. Your family status can open or close other benefit rules. The IRS has tax information. Medicare can use tax information to decide whether you owe a higher premium. Banks monitor transactions for fraud and suspicious activity. Credit bureaus calculate credit scores. The Federal Reserve influences the financial environment and supervises parts of the banking system. Your 401k, Roth IRA, inherited property, mortgage, and savings account all matter to your financial life, but they do not all feed into the same Social Security retirement formula. Here is what almost nobody understands. A system can know a great deal about your financial life without using all of that information to calculate your retirement benefit. Those are two different ideas. Your bank may flag an unusual transfer. A lender may look at your credit score. Medicare may look at income information from the IRS. Social Security may compare wage reports with employer tax information. None of that means a $9,000 transfer from your savings account suddenly lowers your retirement benefit or that a 620 credit score reduces your Social Security check. Retirement benefits are not calculated from your credit score or your checking account balance. They are primarily built from your covered lifetime earnings and the age at which you claim, with additional rules for family benefits and other situations. Start with the work record. Employers send wage information that becomes part of Social Security's earnings records. For self-employed people, tax reporting through the IRS is critical. Social Security and the IRS also have reconciliation processes that compare employer wage information and tax information. If the numbers do not line up, employers can be asked to explain differences. That sounds technical, but the everyday meaning is simple. Imagine your working life as a long row of labeled boxes, one box for every calendar year. In each box sits the amount of earnings Social Security credited to you for that year. When your retirement benefit is calculated, Social Security does not simply add every dollar you ever earned and divide by your age. The system indexes earlier earnings and generally uses the highest 35 years in the retirement calculation. 35 years. That number changes everything. Suppose you worked for 42 years. Social Security does not necessarily use all 42 years. Lower years can fall out of the calculation. Now, suppose 1 year is missing. If the missing year would have been one of your highest 35 years, correcting it may matter. If the missing year was a very low-earning year, and you already have 35 higher years on the record, correcting it may be important for accuracy, but may not increase your retirement payment. This is why the sentence, "I found a missing W-2" is not the same as "Social Security owes me $7,800. Now imagine a different person who worked only 31 years under Social Security. 4 years in the calculation may effectively be zeros. A missing year that should have contained solid wages can be much more important for that person. The same missing $40,000 can have a very different effect depending on the rest of the earnings history. Most people never realize this. They hear missing earnings and assume there is a fixed refund. There is no universal refund amount. The effect depends on where that year sits inside the person's actual 35-year calculation, how the earnings are indexed, the benefit formula that applies to that worker, and the age at which benefits began. For a worker first eligible in 2026, Social Security's formula uses specific breakpoints in average indexed monthly earnings. I do not want you to memorize the technical name. Think of it as 3 shelves. Dollars on the first shelf are weighted more heavily, dollars on the next shelf less heavily, and dollars on the highest shelf less heavily still. In 2026, those breakpoints are $1,286 and $7,749 of average indexed monthly earnings for a worker first eligible that year. The formula applies 90% to the first part, 32% to the next part, and 15% to the amount above the second breakpoint. That is why two people who correct the same amount of earnings can see different changes in their basic benefit. Here's a simple illustration, not a personalized calculation. If a correction ultimately adds $42,000 of indexed earnings to the 35-year total, dividing that by 420 months changes the average by $100 a month. Depending on where that $100 lands in the formula for a worker first eligible in 2026, the basic benefit effect might be roughly $90, $30, or $15 a month before other adjustments. That is a huge range from the same $42,000 change in the 35-year total. Then claiming age can change the payment again. This is why anyone guaranteeing you a specific retroactive amount before seeing your full record is not doing a serious calculation. And there is another detail that gets missed. Social Security says recent earnings may not appear immediately. The agency's own earnings record guidance tells people that current year or last year earnings may simply not have been posted yet, and even suggests checking the statement in August to make sure the prior year is correct. That is very different from saying Social Security launched an August payout program. One is a routine record-keeping recommendation. The other is a viral claim that would need an official announcement. So if you open your record in August and last year is missing, do not panic. Look at the year before that. Look at older years. Compare the pattern. If you worked for the same employer for 10 years and 1 year in the middle suddenly shows 0, that deserves attention. If you changed your name after marriage or divorce, if an employer reported the wrong Social Security number, if a company made a reporting error, or if you were self-employed and a return was processed differently than you expected, that deserves attention. The point is not to assume fraud. The point is to notice an inconsistency. Social Security has an official form for this. Form SSA 7008 is called Request for Correction of Earnings Record. The form asks for the years or months you believe are wrong, the employer, the correct Social Security wages, and the evidence you have. The agency's guidance says useful proof can include a W-2, tax return, pay stub, or other wage records. If you do not have the documents, that does not automatically end the matter. You can provide information about the employer, where you worked, the dates, how much you earned, and the name and Social Security number used at the time. But evidence matters. A memory is not the same as a W-2. This is the first major revelation. The best protection is not asking, am I part of a group of 4.4 million? The better question is, can I identify a specific year, a specific amount, and specific evidence that does not match my Social Security record? That turns fear into a case. It turns a headline into something that can actually be checked. And this is where the system becomes more complicated, because even a real error can run into time rules. Social Security says that ordinarily an earnings record cannot be corrected after 3 years, 3 months, and 15 days from the end of the taxable year in which the wages were paid. But the word ordinarily matters. The agency lists exceptions. Records can sometimes be corrected later to confirm tax returns filed with the IRS, to fix certain employer reporting omissions, to correct errors apparent on the face of Social Security's own records, or to include wages that an employer reported for a person but that are not showing in the record. There are other detailed exceptions as well, so do not hear 3 years, 3 months, and 15 days and assume an older mistake is hopeless. But do not hear exceptions and assume every 20-year-old error can be fixed. This is not automatic. The exact facts matter. The type of earnings matters. The proof matters. Whether a tax return was filed on time can matter, especially for self-employment. Whether a written correction request was made before a time limit expired can matter. That is why the first thing an experienced person does is identify the year and the type of error before promising a result. Now bring this down to the kitchen table. Picture a 68-year-old retired machinist named Robert. He worked hard for more than 4 decades. He does not think of himself as a financial expert. He thinks of himself as someone who paid what he owed and expected the system to do the rest. His Social Security deposit comes in every month. His mortgage is paid off, but property taxes are higher. Groceries cost more. His prescription costs change. His wife worries about the electric bill in the summer. Robert sees an online advertisement saying retirees may be owed thousands because of a Social Security record error. For 5 minutes, he feels something he has not felt in a long time: relief. Then the ad asks for his Social Security number, date of birth, bank information, and a fee to unlock the increase. That is the dangerous emotional moment. Not because Robert is foolish, because the offer reaches him exactly where retirement feels most vulnerable. He worked his entire life. He knows one mistake could matter. He knows government systems are not perfect. He also knows an extra $400 or $600 a month would change his life, so the promise feels believable. The calmer move is slower. Robert first opens his own Social Security information. He compares his earnings history with old W-2s he kept in a file cabinet. He notices one year from the 1990s that looks lower than expected. He does not send his documents to the company. He writes down the year. He finds 2 pay stubs and an old tax return. Then, he contacts Social Security through an official channel and asks what evidence is needed to review that year. That process may or may not increase his benefit. But Robert has changed the balance of power. He is no longer buying a promise. He is investigating a specific discrepancy. That is the more intelligent way to act, and it becomes even more important when we move from earnings errors to claiming age errors, because people often confuse the two. Your work record determines the base from which your retirement benefit is calculated. Your claiming age determines how that base is adjusted. For people born in 1960 or later, full retirement age is 67. Earlier birth years can have a full retirement age between 66 and 67. If you start retirement benefits before full retirement age, your monthly amount is generally reduced. If you wait beyond full retirement age, delayed retirement credits can increase your retirement benefit until age 70. For people born in 1943 or later, the delayed retirement credit rate is 8% per year or 2/3 of 1% per month. This is why a person can have a perfectly accurate earnings record and still receive a smaller check than a neighbor with similar wages. One claimed at 62, the other waited. It is also why correcting an earnings record does not erase the fact that someone chose early retirement. If your corrected basic benefit is higher, the early claiming reduction can still apply to that higher base. Imagine Susan and Linda, both with a full retirement age amount of $2,000. Susan begins at full retirement age. Linda begins years earlier. Their checks will not match even if their earnings histories are nearly identical. If Linda later discovers a missing earnings year and her base calculation rises, that does not mean Social Security suddenly treats her as though she waited until full retirement age. The correction and the claiming age adjustment are separate gears. This separation matters when someone uses the phrase retroactive benefits. There are several different kinds of back money in Social Security, and people mix them together. A corrected earnings record can produce past due amounts if the corrected record changes a benefit for prior months under the applicable rules. A person who applies for retirement benefits after full retirement age may in some cases choose retroactive retirement benefits for up to 6 months, but not for months before full retirement age. And taking retroactive months can affect delayed credits. A law can also create a specific retroactive adjustment, as happened with the Social Security Fairness Act. These are not the same mechanism. The Social Security Fairness Act is worth understanding because it shows what a real large-scale retroactive event looks like. The law was signed on January 5, 2025. It ended the windfall elimination provision and government pension offset for benefits payable starting in January 2024. Those old rules had reduced or eliminated benefits for millions of people receiving certain pensions from work not covered by Social Security. In March 2025, Social Security reported an average retroactive payment of $6,710 among the payments made at that point. By July 2025, the agency said it had sent more than 3.1 million payments totaling about $17 billion, or that was real. It had a law, a named program, official dates, defined affected groups, official notices, and official instructions. Notice the difference. The Fairness Act did not say every retiree gets the average. Social Security specifically warned that the increase could vary greatly. Some people could get very little more. Others could get more than $1,000 a month. And even within that real program, some people already receiving affected benefits did not need to take action, while people who had never applied for certain benefits could need to file an application. This is not automatic in every situation. You have to claim it when the rules require an application. That is a pattern you should remember. Real benefit changes come with eligibility rules. Real back payments have a legal reason. Real Social Security notices explain the change. A number without a rule is marketing. A deadline without an official source is pressure. A guarantee without your record is a sales pitch. If this information is useful to you so far, leave a like. It helps more people who are close to retirement or already living on Social Security find an explanation that separates real rules from expensive rumors. Now I want to go one level deeper, because the next mistake catches people who continue working after they start Social Security. Many retirees believe that once the first benefit is calculated, the work record is frozen forever. That is not always true. Social Security says it reviews the records of working beneficiaries each year. If new earnings are high enough to replace one of the lower years used in the calculation, the agency can recalculate the benefit. If an increase is due, Social Security says the increase is paid retroactive to January following the year of those earnings. Imagine a 69-year-old named Frank who claimed retirement benefits at 66 and then went back to work part-time. He earns $38,000 in 2025. If that $38,000, after the applicable calculation treatment, is higher than a low year currently sitting inside his highest 35 years, it may replace that year. If the new year does not beat any of the years being used, it may not change the benefit. Again, the existence of earnings is not enough. They have to improve the calculation. This is one reason two retirees can both work after claiming and have different outcomes. One gets a small increase, the other gets no increase. The computer is not rewarding effort. It is comparing numbers inside a formula. Now add the retirement earnings test. If you are under full retirement age and working while receiving retirement benefits, Social Security can withhold some benefits when earnings exceed annual limits. In 2026, for a person under full retirement age for the whole year, the annual earnings limit is $24,480, and Social Security withholds $1 in benefits for every $2 earned above that limit. In the year you reach full retirement age, the 2026 limit is $65,160 for earnings before the month you reach full retirement age, and the withholding rate is $1 for every $3 above that limit. Starting with the month you reach full retirement age, that earnings limit no longer applies. A retiree can look at a year in which checks were withheld and think, Social Security permanently took my money. But Social Security later recalculates the benefit at full retirement age to account for months in which benefits were withheld because of excess earnings. The system is more complicated than a simple penalty. This is why a person who worked while claiming early should not assume every smaller payment was an error. The first step is to identify whether the change came from the earnings test, a Medicare deduction, tax withholding, an overpayment recovery, or the underlying retirement calculation. Here is how I explain this to someone at the kitchen table. Think of your Social Security payment as a paycheck with a gross amount and things that can happen around it. The gross retirement benefit is one number. Medicare can be taken from it. Federal tax can be withheld if you elected withholding. An overpayment recovery can reduce what reaches the bank. The earnings test can cause benefits to be withheld before full retirement age. If you only look at the bank deposit, you are looking at the last line of the story, not the first. That is why your bank statement alone cannot tell you whether your Social Security calculation is wrong. Now we reach family status, and this is where millions of Americans underestimate what they should at least check. Most people think they don't qualify because they worked themselves. They assume spouse benefits are only for a husband or wife who never had a job. That is not the rule. A spouse with a lower benefit on his or her own work record may be eligible for a combined amount that brings the payment up to the higher spouse amount, subject to the rules. At full retirement age, a spouse benefit can be up to 1/2 of the worker's full retirement age benefit. If the spouse claims before full retirement age, the spouse amount can be reduced. Suppose Maria receives $1,100 on her own work record at full retirement age. Her husband's full retirement age amount is $3,000. 1/2 of his amount is $1,500. Maria does not receive $100 plus $1,500. Social Security generally pays her own benefit first and then, if she qualifies, adds enough spouse benefit to bring the total to the higher applicable amount. In this simplified example, that could mean $100 from her own record plus a $400 spouse add-on for a total of $1,500. People often imagine 2 full checks. That is not how the rule works. Now consider divorce. An ex-spouse may qualify under a former spouse's record if the marriage lasted at least 10 years and other eligibility rules are met. For some people, that sentence is worth far more than a viral promise of $7,800, because a person can spend years assuming divorce ended every Social Security connection. It did not necessarily do that. Most people think they don't qualify. They may never ask. But once again, eligibility is not a blank check. Age, marital status, the worker's status, your own benefit amount, and when you file, can matter. Deemed filing rules also apply to many people who are eligible for both their own retirement benefit and a spouse benefit. If you are eligible for both, Social Security generally pays the higher combined amount rather than letting you freely take one while the other grows, except for limited grandfathered situations under older rules. The survivor rules are even more important. A surviving spouse can receive a benefit based on the deceased worker's record. The amount can range from 71.5% up to 100% depending on age and other factors, and a surviving spouse at survivor full retirement age can generally receive up to 100% of the worker's basic benefit amount, subject to the rules and the amount the deceased worker was receiving. Survivor benefits are not simply added on top of your own retirement benefit. Social Security pays in a way that generally brings you to the higher eligible amount. Now imagine a widow named Diane. She is 67. Her own retirement benefit is $1,380. Her late husband was receiving $2,650. Diane assumes she cannot receive anything connected to him because she has her own Social Security. That assumption can be costly. Survivor rules may allow a higher combined payment. But nobody should promise Diane the exact increase without looking at her age, the husband's record, when each person claimed, and the survivor rules that apply. And here is a phrase I want you to remember. You have to claim it. Survivor benefits require an application. Social Security's own guidance says the survivor application is not currently available online. People generally contact the agency. There are situations where a person's family status has changed, and the system cannot pay the correct new category of benefit until the agency has the information and an application is made. This is not automatic. The same principle can apply to a divorced spouse or to someone who never applied because an old rule made the benefit appear worthless. The Social Security Fairness Act created a striking example. Some people whose benefits had been reduced by WEP or GPO were automatically adjusted because Social Security already had the needed claim and payment information. But people who never applied for certain retirement, spouse, or survivor benefits may have needed to file. The date of the application can affect when benefits begin. That is why "the government knows I exist" is not the same as "the government has a valid application for every benefit I could receive." The next layer is Medicare, because many retirees think a smaller Social Security deposit must mean the Social Security benefit itself was cut. In 2026, the standard Medicare Part B premium is $202.90 a month. Many people have that premium taken directly from their Social Security payment. If you owe an income-related adjustment called IRMAA, your Medicare cost can be higher. For 2026, the first IRMAA threshold begins above $109,000 of modified adjusted gross income for many individual filers and above $218,000 for married couples filing jointly. Higher income levels can produce much larger monthly Part B and Part D adjustments. This is where the IRS and Social Security really do exchange information for a specific purpose. To decide IRMA, Social Security generally uses tax information from 2 years earlier when available. For 2026 premiums, that generally means 2024 tax information. So a retiree can stop working in 2026, have much lower income now, and still receive a Medicare premium decision based on the higher income from 2024. Think about the emotional effect. A man retires in March 2026. His salary disappears. He expects expenses to fall. Then he sees Medicare taking hundreds more than the standard premium because his 2024 income was high. He thinks the government has failed to notice that he retired. In a sense, the system is doing exactly what the rule tells it to do, using older tax information. But there is a process for certain life-changing events. Form SSA 44 exists for this reason. If you experienced a qualifying life-changing event and your income went down, you may be able to ask Social Security to reduce the income-related Medicare adjustment. Retirement or work stoppage can be one of the important events when the requirements are met. This is not automatic. You have to request the new decision and provide the documentation the agency asks for. That can help both lower-income retirees and comfortable middle-class retirees, though in different ways. A lower-income retiree may never owe IRMA at all, but still needs to understand why the standard Part B premium is coming out of the check. A comfortable middle-class retiree may cross an IRMA line after a large taxable event, then later experience a sharp drop in income after retirement. Knowing that there is an SSA 44 process can prevent months of frustration, but do not mix this with the earnings record. A large 401k withdrawal can raise taxable income and may affect Medicare IRMA in a later year. It can also affect whether part of your Social Security benefits are taxable under federal income tax rules. It does not become wages in your 35-year Social Security earnings history simply because money entered your checking account. A qualified Roth distribution may have different tax treatment, and inheritance may have its own tax rules. A bank transfer may trigger fraud monitoring. None of those facts automatically rewrite your Social Security earnings record. This is the point where people become vulnerable to anyone who uses a lot of official-sounding words. They hear IRS, Social Security, Medicare, Federal Reserve, banking regulations, artificial intelligence, suspicious activity, credit score, 401k, Roth IRA, inheritance tax, and inflation in the same sentence. It sounds as if one giant machine is scoring them every day and secretly deciding the amount of their retirement check. That is not how the retirement formula works. Yes, financial institutions have anti-money laundering duties and can monitor accounts for suspicious transactions. Banks can file suspicious activity reports when legal standards are met. Yes, federal regulators have issued guidance about protecting older adults from financial exploitation. Yes, Social Security uses computer matching in some programs, has automated wage and fraud tools, and maintains an inventory of artificial intelligence uses. Yes, the IRS and Social Security compare certain employer wage and tax reports, but these systems have different legal purposes. Your credit score is primarily a prediction used by lenders and others to judge credit risk. It can affect a mortgage rate, credit card approval, or other borrowing terms. It does not determine your Social Security retirement amount. The Federal Reserve can influence interest rates and supervise parts of the banking system, but the Federal Reserve does not calculate your retirement benefit from your checking account. Your bank's fraud software can notice an unusual wire transfer, but that does not mean the bank sends a secret, reduced Social Security score to the agency. The monitoring is real. The conclusion people draw from it is often wrong. The better approach is to label the problem before you react. Is this an earnings record problem, a claiming age issue, a spouse or survivor issue, an earnings test issue, a Medicare premium issue, a federal income tax issue, a debt collection issue, a bank fraud issue, a credit issue? Those are not interchangeable. Now I want to show you a quiet tax trap, because it explains why retirees sometimes blame the wrong agency. Under federal tax rules, Social Security benefits can become partly taxable depending on your filing status and the combination of one half of your Social Security benefits plus other income, including certain tax-exempt interest. That is an IRS income tax question. It does not mean Social Security reduced the benefit formula. You can receive the same gross Social Security benefit and owe more tax because your other income changed. Picture a retired couple, James and Carol. Their Social Security together is $46,000 a year. They also take money from a traditional 401k to replace a roof and help an adult child. The withdrawal raises taxable income. At tax time, they discover a larger share of their Social Security is included in taxable income. Later, depending on the amount and the year, the higher income may also affect Medicare premiums. They feel as though one withdrawal was counted 3 times, but the right explanation is more precise. The 401k withdrawal is not Social Security wages. It may be taxable income. Taxable income can affect the federal taxation of Social Security benefits. Modified adjusted gross income from an earlier tax year can affect Medicare ERMAA. Those are separate consequences. Once you understand that, you can plan instead of panic. The same is true with 401k contributions while you are working. Many workers assume that because traditional 401k contributions can reduce current federal income tax, those contributions disappear from Social Security wages. Not necessarily. Employee elective deferrals to a 401k are generally still included in wages subject to Social Security and Medicare taxes. So the number used for Social Security purposes can differ from the taxable wages you focus on when preparing the income tax return. That is one more reason to compare the correct box on a W-2 with the Social Security earnings record rather than guessing from take-home pay. Now consider inheritance. In most cases, property received as a gift, bequest, or inheritance is not included in the recipient's federal gross income simply because it was inherited, though income later produced by that property can be taxable, and inherited retirement accounts can have their own rules. Federal estate tax is a tax on the estate under specific rules, not a routine tax on every beneficiary receiving a modest inheritance. More important for our discussion, inheriting $80,000 from a parent does not turn that $80,000 into covered wages in your Social Security earnings history. This is why I keep returning to the same principle. Identify the category of money. Wages are not the same as retirement plan distributions. Retirement plan distributions are not the same as bank transfers. Bank transfers are not the same as inheritance. Inheritance is not the same as interest income. Interest income is not the same as Social Security covered earnings. When a system uses income, ask what kind of income, from what year, for what purpose. Now tell me in the comments, did you already know that a Social Security earnings correction, a spouse benefit, a survivor benefit, and a Medicare premium issue are 4 different problems, or are you hearing that distinction clearly for the first time? Now we need to talk about deadlines, because urgency can be real even when a viral deadline is not. There is no general official request your $7,800 this month deadline that I can verify. But individual deadlines absolutely exist. An earnings correction can face the 3 years, 3 months, and 15 days rule and its exceptions. An appeal of a Social Security decision generally must be requested within 60 days after you receive the notice, although good cause rules may apply in some late cases. A benefit application date can affect how far back certain benefits can begin. Medicare enrollment can carry its own timing rules and possible late penalties. So the correct response is not, there is no deadline. The correct response is, find the deadline attached to your exact issue. Imagine a 72-year-old veteran named Thomas receives a Social Security notice saying his payment amount has been changed. He places the letter on the counter because the language looks complicated. 3 weeks later, he reads it again. Then he asks his daughter. Then another month passes. By the time he understands that the letter is a decision he disagrees with, he may be close to an appeal deadline. Thomas's mistake is not that he lacked intelligence. It is that official letters often look less urgent than scam messages. The scammer writes, "Act now." The real agency sends 3 pages of calm language. People sometimes respond faster to the scam than to the real notice. So when Social Security sends you a decision letter, read the date, the reason, the amount, and the appeal instructions. Do not throw it away just because the bank deposit looks close to normal. A difference of $85 a month is $1,020 a year. Over 5 years, ignoring time value and future adjustments, that is $5,100. A difference of $140 a month is $8,400 over 5 years. Small monthly numbers become large retirement numbers because retirement lasts for years. This is also why inflation matters. Social Security receives cost of living adjustments when the law's formula produces them. In 2026, Social Security benefits increased by 2.8%. A correction to the underlying benefit can interact with later cost of living adjustments as the agency recomputes what should have been paid. But you should not assume that multiplying the current monthly difference by every month since retirement gives the legally correct back payment. The system may need to reconstruct prior rates, entitlement dates, reductions, deductions, and any applicable limits. This is where a legitimate professional can be useful. A qualified attorney, CPA, enrolled agent, or financial professional may help you understand a complex case, especially where taxes, a pension, divorce, survivor rights, or old earnings records overlap. But the professional should be able to tell you exactly what problem is being analyzed. We found a missing 2002 wage year, and here is the evidence is a real issue. Our algorithm says Social Security owes you between $6,000 and $12,000. Pay us first is not enough. Now we come to the most important part of this entire discussion, because this is where a person can protect both the benefit and the identity behind it. Social Security and its Inspector General repeatedly warn about people who promise benefit increases in exchange for information or money. A real Social Security employee will not promise to increase your benefit in exchange for a fee. Scammers have sent messages, emails, phone calls, and even letters designed to look official. Some tell people they need to activate an increase. Others say a Social Security number is suspended. Others use the name of a real government official. The message changes. The pressure does not. The claim about 4.4 million retirees and an average $7,800 payment is dangerous not merely because I cannot verify it as an official SSA announcement. It is dangerous because the numbers are believable enough to lower a person's defenses. We have seen a real event in which millions of people received retroactive Social Security money under the Fairness Act. We know earnings records can really be wrong. We know back payments really can happen. A scammer does not need to invent an impossible story. The most effective story is usually 80% familiar and 20% false. Watch how this works. A retiree receives a message saying, "A new SSA review found underpayments. You may be owed $7,800. Confirm your identity before the deadline." The retiree searches online and finds genuine articles about Social Security retroactive payments. He remembers hearing about WEP and GPO. He knows friends who received money. The claim now feels confirmed, even though he has verified the wrong program. Then he clicks. That one click can be more expensive than the benefit error he was trying to fix. A Social Security number, date of birth, mailing address, Medicare number, bank routing number, and copy of a tax return can give a criminal enough pieces to attempt identity theft, account takeover, fraudulent credit, or changes to financial accounts. Banks do monitor unusual activity, and that monitoring can protect people. But no system catches every attempt before harm occurs. Protection begins before the data leaves your hands. Here is the rule I want you to use. Never give a private company your full financial identity merely to learn whether a public record contains a visible discrepancy that you can check first yourself. You do not need to understand the entire Social Security Act to perform the first review. You need your Social Security statement or online earnings history. You need to look at the years. You need old W-2s if you have them. If you were self-employed, you need tax returns and records that support the self-employment income you actually reported. You need your original or recent benefit award notices if the question is the amount you receive. You need to know the month and year you started retirement benefits. You need your date of birth so you can identify full retirement age. If a spouse, ex-spouse, or deceased spouse may be relevant, you need the basic marriage, divorce, and death information. If you worked after claiming, note those years. If Medicare is taking more than you expected, read the Medicare or IRMA notice separately. That is the basic file. Notice what is not on that first page of homework. You do not need to send a stranger your online banking password. You do not need to move money into a protected account. You do not need to buy gift cards. You do not need to pay someone to activate a cost of living adjustment. You do not need to give a caller remote access to your computer. You do not need to believe that an official benefit expires at midnight because a text message says so. Now, let us take each basic record and show what it can tell you. Because this is where most people discover whether they have a real question or only a frightening headline. Your earnings history tells you whether the years and Social Security earnings look plausible. Do not compare it only with your memory of salary. Compare it with W-2 Social Security wages when possible. A person earning $75,000 may have different numbers in different W-2 boxes because income tax wages and Social Security wages are not always identical. There is also an annual Social Security taxable maximum, so earnings above the maximum for a year do not increase Social Security covered earnings beyond that cap. In 2026, the Social Security wage base is $180,500. Medicare tax does not use that same wage base limit. That is one more reason the numbers on a W-2 can confuse people. If you see exactly zero in a year you know you worked full-time, mark it. If you see $12,000 in a year when your W-2 says $62,000 of Social Security wages, mark it. If you see a difference of a few dollars, do not immediately assume the benefit is wrong. First, make sure you are comparing the correct type of wages. If a recent year is missing, remember that reporting can lag. If an older year is missing, gather evidence. Your benefit notice tells you something different. It tells you the amount Social Security decided to pay and often explains why. If the notice reflects an early claiming reduction, that is not an earnings record error. If it reflects a spouse or survivor decision you think is wrong, that is a benefit entitlement question. If it reflects an overpayment recovery, that is another category. If Medicare is deducted, that deduction can make the bank deposit lower even when the gross Social Security amount did not change. Your claiming date is another basic fact. People often remember the age but not the month. A few months can matter. Delayed retirement credits are earned monthly after full retirement age up to age 70. Early retirement reductions are also applied by month. A person who says, "I waited until 67" may actually have filed several months before full retirement age if his full retirement age was 67 and the benefit began earlier than he remembers. The notice and online record are better than memory. Your family history is not personal gossip in this context. It is an eligibility fact. A 10-year marriage can matter for divorced spouse benefits. A former spouse's death can matter for survivor benefits. A current spouse's work record can matter. A child with a qualifying disability can matter in some family benefit situations. The question is not whether you feel financially connected to that person. The question is whether Social Security law recognizes a benefit relationship. Your work after retirement matters for two different reasons. Before full retirement age, earnings can trigger the retirement earnings test. At any age, later covered earnings may be reviewed to see if they increase the benefit calculation by replacing a lower year. Those are separate mechanisms. One can reduce or withhold checks temporarily before full retirement age. The other can increase the underlying calculation if the new year is high enough. Your Medicare notice matters because Medicare deductions are often mistaken for Social Security errors. If you are paying IRMA in 2026, look at the income year Social Security used. For many people, that will be 2024. Then ask whether a qualifying life-changing event reduced your current income. If so, Form SSA 44 may be relevant. Again, this is not automatic. You have to request a reduction when the rules require you to do so. If you want to keep receiving explanations like this, consider subscribing to the channel and turning on notifications so you do not miss the next video. The rules change, the numbers change, but the habit that protects you is the same. Verify the official rule before you move money or hand over personal information. And your tax return matters, but for a specific reason. It can help document self-employment income. It can explain Medicare IRMA. It can help you understand why Social Security benefits were taxable. It is not a magic sheet that proves every wage discrepancy. If you were an employee, W-2 information is often central to the earnings question. If you were self-employed, filing history becomes especially important because correction rules can be stricter after the normal time limit. Now I want you to picture the system as a quiet set of gears turning behind a wall. One gear receives wage reports from employers. Another stores your lifetime earnings record. Another indexes earnings and selects the highest 35 years. Another applies the benefit formula. Another adjusts the amount for claiming age. Another checks whether later earnings replace an earlier low year. Another applies family benefit rules. Another handles survivor claims. Another receives tax information used for Medicare IRMA. Another handles federal tax rules. Another bank system watches for suspicious transactions. Another credit system estimates lending risk. Another fraud system looks for unusual patterns. The mistake is imagining that every gear turns every other gear. A bank suspicious activity system does not decide your 35-year Social Security average. Your credit score does not set your Medicare Part B premium. Your inheritance does not become Social Security wages because it was deposited into a bank. A 401k distribution does not add a new earnings year. The Federal Reserve does not secretly lower an individual retiree's check because interest rates changed. Artificial intelligence used for fraud detection is not the legal formula for retirement benefits. But some gears do connect. Employer wage reporting connects to Social Security earnings records. IRS information can connect to Medicare IRMAA. Work after retirement can connect to the earnings test and later benefit recomputation. A spouse's or deceased spouse's work record can connect to family or survivor benefits. Those are the connections worth learning. This is happening quietly because most of the process is automated and routine. There is no person sitting at a desk each month deciding whether you deserve $2,100 or $2,140. Most of the time, the system processes the data it has according to rules. That is exactly why data quality matters. A computer can process incorrect input very efficiently, and that is the climax of this entire issue. The hidden risk is not that Social Security secretly discovered $7,800 for everyone and hopes you never ask. The hidden risk is that a real individual error can sit inside a routine system for years because the system has no human memory of the job you worked, the name you used, the spouse you divorced, the employer that reported a wrong number, or the document sitting in your filing cabinet. The system sees the record. You remember the life. When those two do not match, you need evidence. That is the moment a review can matter, not because 4.4 million strangers were mentioned in a headline, because your 1998 W-2 says one thing and your earnings history says another, because your 2025 earnings were high enough to replace a low year and you want to understand whether the annual recomputation occurred, because your spouse died and you never filed for survivor benefits, because your 12-year marriage ended in divorce and you assumed the ex-spouse's record could never matter, because your Medicare premium is based on income from before retirement and your present income dropped after a qualifying life event. Because a Social Security notice contains a decision you believe is wrong and the appeal clock is running. Those are real reasons to act. Now let me give you one final example that pulls everything together. Imagine Evelyn, age 70. She receives $1,160 a month before Medicare. She worked for 34 years, took time out of the workforce to care for 2 children, and later returned to work. Her husband died 3 years ago. She has a modest IRA, a paid-off home, and $48,000 in savings. She is exactly the kind of person scammers target because she is financially careful but not interested in technical rules. Evelyn sees the $7,800 claim. She thinks, I only worked 34 years. Maybe I am one of them. That is a reasonable thought. But instead of paying $490 for a benefit audit, she opens her earnings history. She finds that her 34 working years are all present. 1 year is low because she only worked 4 months. Her own earnings record may be accurate. So the viral claim has not found anything. Then she looks at her husband's information. She realizes she never had a full conversation with Social Security after his death because she believed her own retirement check disqualified her from survivor benefits. Now she has a real question. The important issue was not the missing earnings record she feared. It was family benefit eligibility she had never reviewed. Suppose Social Security determines that her survivor benefit is higher. The result could be far more important than the advertisement that frightened her. Or suppose the agency determines that her own amount is already the higher payable amount. Then she knows. Either way, she obtained the answer without giving a marketing company her bank password. Now change one fact. Evelyn's husband is alive, but she worked 34 years and has 1 0 year. She goes back to work in 2026 and earns $52,000. If that covered earnings year enters her highest 35 and replaces a 0, her future retirement calculation may improve. Social Security's annual review of working beneficiaries could produce an increase. That is another real path, with a different rule. Change one more fact. Evelyn retired in 2026 after earning $160,000 in 2024. Her Medicare Part B premium is above the standard amount because of IRMAA. Her current income is far lower after retirement. Now SSA 44 may be the important form. Same person. Same monthly deposit. Completely different problem. This is why one headline cannot diagnose a retirement benefit. The people who protect their money best are not necessarily the people who understand every regulation. They are the people who refuse to let different systems blur together. They ask, what number changed? Which agency changed it? What year of information did they use? What rule did they apply? Is there an official notice? Is there an official form? Is there a deadline? What evidence do I have? That is financial self-defense. This content is educational and general. It does not replace personal financial, legal, tax, or accounting advice. A complicated Social Security case can involve facts that change the answer. But you can still do the first layer of checking yourself, and that first layer is often enough to tell you whether you need professional help. So before you pay anyone to review your Social Security, make a simple comparison. Open your Social Security earnings record. Compare older years with W-2s, pay stubs, tax returns, or other wage records. Note any year that is clearly wrong. Confirm the month you started benefits and your full retirement age. Ask whether you worked after claiming. Review whether a current spouse, ex-spouse from a marriage of at least 10 years, or deceased spouse could create another benefit question. Separate the gross Social Security amount from Medicare and other deductions. If Medicare is unusually high, check the IRMAA notice and the income year used. Keep official letters. Do not ignore appeal instructions. Then, contact Social Security through an official channel if you find a concrete discrepancy or eligibility question. Most important, do not let anyone turn uncertainty into a guaranteed dollar amount. There may be retirees who are underpaid because an earnings record is wrong. There may be people who can receive past due money after a correction. There may be spouses, divorced spouses, and survivors who qualify for more than they receive now. There may be people whose Medicare ARMA can be reduced after a qualifying life-changing event. There may be working beneficiaries whose new earnings should increase their benefit. But every one of those sentences contains a condition. This is not automatic. Most people think they don't qualify. Nobody is going to tell you about this in the exact moment you need it unless you ask the right question. You have to claim it when the rule requires a claim. And this helps both lower income retirees and comfortable middle-class retirees because losing $75 a month matters when money is tight, and paying hundreds too much for the wrong reason matters even when you have savings. The goal is not to be afraid of Social Security, the IRS, Medicare, banks, credit bureaus, or technology. The goal is to know what each system is actually doing. Once you know that, the fear becomes smaller and your questions become better. You worked for decades to build a life. Maybe the house is modest. Maybe the 401k is not as large as you hoped. Maybe you are helping children or grandchildren. Maybe medical costs worry you more than market returns. Maybe inflation has made a retirement check that once felt comfortable feel tighter every year. That is exactly why small errors deserve attention, not panic. Attention. If you find a mistake, document it. If you receive a decision you disagree with, read the appeal deadline. If a family change could affect benefits, ask about the right category. If a Medicare premium is based on old income and your life changed, find out whether the SSA 44 rules fit your situation. If somebody promises a guaranteed increase for a fee, slow down. If a message asks you to move money, send gift cards, or reveal private information to protect your Social Security, stop. You still have time to be more deliberate than the system. The government has records. You have records too. The bank has software. You have judgment. A scammer has urgency. You can have patience. And that difference is often enough to protect years of work. Share this video with a spouse, a brother or sister, a parent, a retired coworker, or anyone who depends on Social Security and may never have checked the earnings history behind the payment. A careful review does not guarantee thousands of dollars. It does something more valuable first. It tells you whether there is a real problem. And if you think this is important, watch the next video appearing on the screen now. In it, I explain another situation that can quietly change the amount retirees actually keep each month and the simple records you should check before assuming the government or the bank got it right.